example, the gifting, there's an annual gift tax exclusion, and that's a little different. That is something that's outside that basket that I just mentioned. And that's every year you are allowed to gift up to $16,000 in value, property, cash, whatever, to any particular person. Your spouse can join you in that and double that for a particular person. Or you can gift to somebody and their spouse, and end up being able to double that. So those amounts that are done annually are just kind of a freebie. They go outside of the exemption, and they're a way of getting some of the assets out of an estate, or doing some other kind of planning that you're interested in doing, and not having it impact that the exemption, the unifying exemption amount that I mentioned.
And so that if someone was gifted $16,000, that'd be the receiver who doesn't have to pay the tax, correct?
Well, the receiver never has to pay the tax.
Oh, okay.
This is all related to the person who owns the property and is giving it up.
Got it.
Yeah. So the person receiving the gift, really, there's no tax implications. However, it depends what they're getting. So, for example, if I am giving my son a piece of property that I've had for 50 years, it may have very little basis, meaning that there's a lot of capital gains potentially attached to that asset.
Yeah.
If I gift it in my lifetime, they get a carryover basis. So they have a very low basis, and potentially they go sell that property, they're going to have gain. Now, if I died, and you get what's called a step-up basis on death, meaning all the assets are revalued to the date of death. So if that piece of property, I died with that piece of property in my estate and it went to my son, he now gets the fair market value of that property as his basis. So in that case, he would have no tax implications to selling it. So that's a big consideration when you're deciding whether to gift, whether to keep an asset, until you die, potentially.
Yeah.
I'm trying to, so as far, and then there's also something called income in respect to decedent. And so if you die with an IRA that's deductible, meaning that you deducted it, against your income while you were alive, that income you can't revalue that asset. That income component stays in place and has to be paid by whoever takes over that IRA. So under those would be the two main circumstances under which somebody getting a gift or getting an inheritance would potentially have a tax situation. For the most part, when you get inherited property, you're not going to have any tax implications for that individual that you have to worry about.
Awesome. All great information. And so then how is lifetime gifting used to minimize estate and income tax?
So, as I said, it's kind of as far as the actual estate tax goes, it's kind of less important. But what happens with a lifetime, when you're moving your assets out of your pool of assets during your lifetime, you're transferring the appreciation on that asset to the person you're giving it to. So if you're looking to try to reduce the amount of assets, the value of your assets when you die, then obviously, if you have a highly appreciating asset and you can move it out to gift it to somebody who you want to ultimately have it, then that's one consideration. And that's one reason why it might be better to do it now rather than, 50 years from now or 60 years from now. There's also, let's see, I'm trying to think my train of thought here. You can there's also when you do gifts, there's also the potential that you can discount that asset. For example, you have a family limited partnership or family LLC, and so you take a chunk of assets and you move it into that family LLC, and you're going to give ownership percentages to your children, for example. And you can do that, annually each year. You can give a little bit. You can chip away at that using that 16,000. But if you move all of those assets into a partnership, oftentimes there's justification for discounting it, because now it doesn't have marketability. It doesn't have the same marketability it had when you owned it yourself. Now there's other people to be considered. So, there's issues with the ease at which it can be transferred.
Right.
So there are discounts. There's a lack of marketability discount. There's a minority interest discount. There's various discounts that IRS recognizes as legitimate reasons to say that now this asset, this asset that I had here that was worth $10,000, I've now moved it into here, and now it might be worth, something less than that. So,
interesting.
It's another way of, kind of minimizing the value while still maintaining control. Obviously in that situation, usually the donor retains the majority interest, so that they still can control, make the decisions about the property, or make the decisions about the business, or whatever the asset is. So, so that's another reason that you might want to do a gift. You can also give gifts into trusts. I know we're going to talk a little bit about trusts.
Yeah.
You can gift assets into an irrevocable trust, which you relinquish control of it, but you've structured the trust in such a way that it's going to do what you want it to do, and it's going to accomplish, whatever structure, whatever strategy that you want to have happen with that asset, and whoever you're giving it to, and what kind of constraints you're going to put on those people, as far as what they can do with it and when they can have it. That's, it's obviously very helpful for minor children. If you want to do something, you want to transfer it to them, but you don't really want them to have free reign of doing whatever they want with it, then structuring that in a trust still accomplishes you relinquishing it, as long as it's irrevocable. But you still kind of control, what will happen to it in the end.
Awesome. So yeah, kind of going into these trusts, can you explain some of the different types of trusts out there and how they're used for like managing and conserving the wealth and reducing your taxes?
Sure. So, the basic structure of tax planning, estate planning, is obviously you want a will. Everybody's got to have a will. Then beyond that, you usually have a grantor trust, which is, or donor trust. There's a few different names for them, but basically that's a trust that exists during the lifetime of the individual who created it, the grantor. They still have complete control over all of their assets. They can buy them, sell them, do whatever they want. They can change the trust. There's really no, they don't have their hands tied, as far as what to do with it. But in the meantime, they've transferred title to the grantor trust, so that everything is in one basket. It's in this trust. It's disregarded during their lifetime for the most part. Usually, there's no tax return. It's all reported on their personal income tax return. However, what it does is, if that person should be incapacitated, then somebody can step in. Whoever's the successor trustee, who's designated in the document to be the successor trustee, can step in and manage those assets. So it makes it, much easier than having to go through other processes to accomplish that. And also, when they die, it can escape probate, which, probate is a cost associated with settling an estate, if there are assets that are not in trust. So getting all of those assets into a grantor trust during the individual's lifetime and having everything titled correctly saves potential problems with having to manage those assets, but also can save costs associated with settling the estate down the road. It can also, and usually what happens is the grantor trust will specify what's going to happen upon death. So you oftentimes will have a husband and wife have a joint grantor trust, even, where it's just that they're both grantors, it's both of their trusts. And then when the first spouse dies, then certain mechanisms are put into place that the trust document stipulates. And usually it's split into two trusts, a marital trust and a bypass trust are the ones that I've heard. I mean, I'm from New Mexico. I've practiced in New Mexico longer than anywhere else. So that's what I'm familiar with. I'm sure in other states there might be other terminology, but I think, I think the gist of it is the same. So the marital trust kind of remains the grantor trust for the surviving spouse. They still have access to that money and can have it for whatever purpose they need. And then the bypass trust it carves out, typically if necessary, it would carve out that exemption amount that, say, okay, we're going to take $12 million of this individual's assets and put it in a bypass trust. And then what that does is it goes outside of their estate, and it goes to the individuals that they have designated would have it. Usually, for grandkids, whatever. So what that does is it uses up that exemption amount, but then it goes out. It skips this. I should rephrase that. It skips the surviving spouse's estate. It's taxed in the first person to die, their estate.
Got it.
Then goes out, then it bypasses the spouse's estate by virtue of she doesn't have ownership to, or I say she, it's usually the surviving.
We do live longer. It's just a fact.
It goes. So yeah, the surviving spouse then oftentimes they still have access to income or things if they need it. There's provisions that allow the trustee to make that decision and say, okay, we're going to take some of that money, even though it really doesn't belong to her anymore. And it's still okay. It's still outside of her estate. So that's the usual structure, that you see, the kind of boilerplate stuff. However, there's there's a life insurance trust, which is set up with a life insurance policy. Usually no tax consequence, no gift tax consequences to setting that up. And you can you transfer a life insurance policy into an irrevocable trust, basically. And you can use the annual gift tax exclusion to pay premiums. So that, that $16,000 that I was talking about, you can use that to pay premiums on the life insurance. So that's one strategy, which is really good because typically an individual they can relinquish that asset with no impact to their current situation. Because, it's just sitting there. They're not using it for living, for expenses or anything. So that's life insurance trust is another really good strategy for tax planning. There's a qualified personal residence trust, which you can transfer a residence into, use it during the lifetime of the individual who transferred it, but it's irrevocable. So again, it can pass outside of the estate upon death. So it gives them the right, gives them the ability to still have the house, live in the house and all of that, but move it out of the estate. Then there's a grantor retained annuity trust. I mean, there's a lot of different trusts. They all, they kind of all have a similar flavor, but that a little nuances. That one is good for if you have appreciating value. If you're expecting assets to appreciate in value over a short period of time, that's a good one because you guarantee the grantor gets a certain percentage gets an annuity, so to speak, of some of the income that it's throwing off, but it still moves it out of the estate. So that can be helpful. And the last one I'll mention is charitable. There's two kinds of charitable trusts: charitable remainder trust and a charitable unit trust. And those are really used primarily for charitable purposes. You set those up. You designate certain charities to receive the money, the assets after either a certain period of time or upon your death. During your life, you get a percentage. It's again kind of like an annuity. You get a percentage of those assets are are given out to you based on the income that's generated each year. So you do still continue to get some benefit from that. You pay tax on that. But you've designated charities to be the remainder beneficiaries, at the end of the trust. And by doing that, you generate a big charitable contribution deduction up front at the beginning when the trust is first created. That can be used by the donor, and then the assets are passed on to whatever charity that they've designated. So
it seems like, there's a lot of options out there. You really want a professional help you out with, making sure you have the right trust, making sure everything's in place properly, and, making sure you have all the people that you want all your items designated to as well.
Exactly. Yeah, and know what's in the trust. It's amazing how many clients I've had that come in and they don't understand that it's irrevocable. They don't understand that they really can't do whatever they want to do with their assets anymore. And so, I think it's important when you're having those drafted, and that you thoroughly review them and you thoroughly understand what you can and cannot do within them.
Yeah, that is important to know. So are there specific types of assets that are better to fund trust than others?
That depends on what you're trying to accomplish and the type of trust that you choose. As we mentioned a little bit, like assets with a very low basis might not be a good idea for going into an irrevocable trust, because they're going to get that basis and it's not going to change. Whereas if it's in a revocable trust and then the individual dies, it gets brought back into their estate, but they also get a step up basis. So, you can still limit access, can retain some control, but still not saddle the individual who ultimately gets it with a potential income tax liability. Again, it's hard to, that question has to be answered in the context of what is the individual trying to accomplish? And what are the assets? Sometimes appreciating assets are good to get out of the estate if you're doing it right. And sometimes, undervalued, ones are not. Real estate, oftentimes having real estate in a trust, in a land trust, there's a whole body of knowledge related to just real estate assets alone about the best way to structure that to protect you from liability, to make sure that ownership is retained the way you want it to be retained, and that kind of thing. So the answer to that question is it depends on all of the factors and the reasons for doing the trust, and the eventual outcome that you're hoping to accomplish.
So then, do you work a lot side by side with attorneys and things like that to help make sure people get the best, tax benefits?
Yeah, I do a lot of, I've become, I had a friend say, well, you're not an attorney. You can't be giving this kind of advice. And I'm like, well, they know I'm not an attorney, and I, make sure that they understand, what my wheelhouse is here. But yeah, it's like, they're so connected,
right.
what your assets are, what your income is, what you're trying to accomplish, is so integrated with the kinds of tax documents that you have set up with your attorney, and what you're trying to accomplish. And like I said, a lot of people just, they'll go to an attorney and they'll get a set of documents and really won't understand what's in them. So, it's been a lot of times I'm educating my clients about the documents they have and what they already have in place, because they might just not, because and it's no fault of the attorney. It's just when you're looking at 30 pages of a legal document, everybody kind of gets glazed over at some point, right? So
definitely,
it's much better if somebody just tells you this is what it says. So
definitely, yeah, because it seems like it's very intertwined. Just making sure you want to have the best deals, but still access your money and all these different moving parts. So it definitely does take a team of professionals to make sure you're doing what's best for you and your unique situation, and everything's going where you want it to.
yeah, and I mean, attorneys are, you've got to have an attorney who's in your state, who knows your law. Laws are, I've learned that more so than ever with real estate, state by state, they're all different. So you really, you want to have somebody who's in your resident state who can make sure that the documents that they're drafting are going to accomplish what you need to accomplish. But yeah, I think, obviously then it's my turn to say, okay, so here's what it says, and here's what that means, and here's the nuts and bolts of how that works in the economic calculations of everything.
Yeah. Well, we've covered a ton of great information. Is there anything else that we didn't touch on that you want to make sure is shared today before we wrap up?
No, I think we've been as thorough as we can in this shorter period of time with this, topic. And hopefully, again, I don't want to give, I have a tendency to give too much information and, have to dole it out when people are, what people really want to hear and need to hear at that moment. So,
yeah. But no, it's a great way to just get started, get thinking, think about your own situation. But if people do have more questions, feel free to reach out to Tracy. Her email's been going through the bottom here. She's also one of our Purse Strings approved professionals, so you can check her out on our site, pursestrings.co. And we will be back here next week with one more tax topic, talking about business taxes. So we appreciate everyone sticking with us this month talking about taxes. It's going to be fun. We love it. So thank you, Tracy, for coming on today, and we'll talk to everyone soon.
Thank you, Maggie. Appreciate it.
All right. Bye-bye.
Bye-bye.